This is News You Can Use.
Last week, the Federal Reserve once again raised short-term interest rates by 25 basis points. Some experts predict another rate increase later in 2023. However, mortgage rates are not expected to be significantly affected, as they are already near their peak. As we've discussed repeatedly on this program, the Federal Reserve has executed its interest rate hiking campaign in an effort to combat inflation. The most rapid and significant interest rate increases ever to tackle inflation, which hasn't shown up in the last 50 years. As you can see from this graph showing the correlation between inflation and interest rates, the Fed's efforts, they're working. Inflation is down to about 3% year over year from a high of over 9% in June of last year. The federal funds rate impacts all short-term borrowing for Americans, from credit cards to auto loans, and yes, what you and I are most concerned about, mortgage interest rates. Higher interest rates are intended to thwart consumer demand and thus lower inflation. As you can see from the following chart showing the historical correlation between mortgage interest rates and year-over-year inflation, mortgage rates typically hover about 2% above year-over-year inflation. Bearing this in mind, interest rates today in the low to mid 7% range are now running quite a bit higher than the historical average, which would have interest rates today around 5% based on inflation. Inflation is now at 3%, and so interest rates should be around 5% based on historical standard. So why are interest rates still significantly higher on mortgages? The reality is that the federal funds rate is a blunt instrument, and interest rates take a moment to trickle through the economy and have their full impact. The Federal Reserve is going to be reluctant, therefore, to begin lowering short-term interest rates until they feel more confident that inflation is indeed more permanently in check. According to Fed Chair Jerome Powell, future decisions on rate moves would be based on incoming data rather than a preset course on policy. Central bank officials generally believe that inflation is still a bit too high despite the recent positive trends, and they want to see multiple months of solid data continuing these trends before changing directions. So, when can we get relief from today's 30-year fixed-rate mortgage rates that are causing real strain on you and I and on your home buyers' affordability? That's the trillion-dollar question. Barring any unforeseen events, the Federal Reserve should either pause any future rate hikes and even begin lowering interest rates later this year. However, several indicators will steer, data-wise, their decisions. Number one, employment. Believe it or not, adding fewer jobs to the American economy would actually help to lower inflation. More people with jobs equals more people with money and therefore more demand for goods and services. I would never pray, and I know you wouldn't either, for fewer of my neighbors to get jobs. Well, maybe we would pray that you just wait another month or two to get them. We'll be tracking the next jobs report released by the U.S. Department of Labor later this week on August 4th. Stay tuned. Again, a lower number of jobs created will give more confidence for the Fed to pause and begin then consideration of lowering interest rates. Number two, inflation. The next consumer price index will follow 1 week after the jobs report. The Federal Reserve wants to get inflation down to 2. We're currently at 3. Any tick downward would strengthen the case that we've seen enough interest rate hikes, and we can therefore then start to expect relief in the mortgage markets. As you know, it's been a challenging season in housing and in the housing finance industry. Fortunately, seasons change, and it looks like better days are coming soon. And this is News You Can Use.